money, let's say you have your money in the checking account so that you're the
Trustee.
trustee. Is the money insured? Let's say I have $2 million in there and only.
Well, where are you going to keep the money?
Well, I mean, you know.
Well, okay, let me answer that for you. The banks, they provide FDIC insurance up to $250,000. So if you wanted to have FDIC insurance on your $2 million, you just got to set up, 8 accounts, or I think 8 accounts. But again, now, are you going to keep your money at the bank, at the checking account or savings account, collecting 0.005%? No, you're not going to keep your $2 million. It's going to be a short term. You're going to be investing the money. So, I mean, yeah, it's a good question, but to me, it's not, really, important question, because you're not going to keep your money at the bank. Yes, you need to keep reserves, X amount of dollars, but you're not going to keep most of your money in the bank just sitting there. Yeah, you will for a period of time until you found the investment, and you put money in that investment. Now, obviously, no one is going to give you FDIC insurance on, if you buy an investment property. Every investment comes with the risk. So you gotta, again, you gotta invest in what you understand. So if it's, flips, if you do that, great. If it's, business, great. But you've got those options available for you. Okay, and that's really easy to operate. The filing requirement that you need to do with the IRS is if your balance exceeds $250,000. Then there is a simple form called 5500 EZ that is filed with the IRS. And all of this is just an informational return. You have to let IRS know what the value of your account is and how much you contributed to that year. That's it. If it's under 250, you don't have to do anything. Very simple. Exempt from unrelated business income tax. Another big benefit. And now, with an IRA, if you have a self-directed IRA and then you decide to buy an investment property, a rental property, and you decide to finance a portion of the purchase price with a non-recourse loan, let's say it's $100,000 purchase price. You put $50,000, you get a loan for $50,000. Well, the income that comes from the finance portion of the property is a subject to unrelated business income tax. And that's about 35%. Even though it's inside of a retirement account, because you're actually now engaging in an activity that is not directly related to the retirement account itself, because you're financing the property. The sole 401k is exempt from that rule. Just another reason why set up a sole 401k, buy an investment property with leverage financing. That's what I'm doing. Find a property in Phoenix, Arizona currently. Putting 40% down, financing the rest. Another reason to do a sole 401k. Talking about that. Here's the process. The process, again, of setting up the plan is very simple. First, you gotta have, obviously, a legitimate business, and then you decide, yes, I want to adopt the plan. The business adopts the plan. The plan is established. We create all the plan documents for you. If you have an existing IRA or 401k, we help you transfer those funds into your newly established account. Or you can just make a contribution and fund it that way. And remember, with an IRA, because of the limit of 5,500, it's going to take you several years to build that up. With solo 401k, if you make an income in your business, you can actually build that up pretty quickly. 50,000 a year. What if your spouse is part of it also? Or if your spouse is not part of your business, make your spouse part of your business. And your spouse can do something else, but can be just involved and help you with some paperwork, some accounting, or whatever, some bookkeeping. Just help you in the business. Then they can also have an account, and you both can contribute. And that's, again, another cost saving, because you can have one plan with 2 accounts under it for you and your spouse, and no custodian. makes it really attractive. Once the plan is set up and funded, you make the investment. As a trustee, you just write the check and you make the investment. Simple as that. Prohibited transaction. I talked to you guys that the IRS doesn't have a list of things that you can do inside of your retirement account. They tell you that there is certain transactions that are not allowed. And basically, the transactions, the investments that are not allowed is collectibles. You cannot invest in a collectible using your 401k. If you have an IRA, you cannot invest in life insurance. With 401k, you can. And you cannot, your retirement account cannot conduct business with a disqualified person. And disqualified person is yourself, your spouse, and your immediate family members. It's your kids and grandkids and their spouses, your parents and grandparents, so it's vertical. Now your brother or your cousin or your sister or your uncle or your nephew are not considered a disqualified person. So you can do business with them. Here's an example what the prohibited transactions are. Sell or exchange or leasing of the property between a plan and disqualified person. So if you already own a property in your name and you want to set up a plan, and then people say, well, can I transfer my property in my 401k? No, you cannot because you own it. Transfer means you selling the property to your 401k. You cannot do that. You cannot do any business, your IRA cannot do business with yourself. If you have a 401k and you buy a rental property, you can't rent it to your parents. They cannot be tenants, or your kids. Or if your father is a contractor and your plan owns the property, you can hire your father to go and do the work on the property. If your brother is a contractor, fine. He's not a disqualified person. Lending money or extension of credit between a plan and a disqualified person. That is why you cannot get a conventional loan. If you buy a property inside of your 401k, you have to get a non-recourse loan. And non-recourse means that you personally not guarantee it. So if you buy a property in your name, what's the process? How do you do? Where you go? You go to the bank and say, hey, Mr. Banker, I'm buying this property. Here's an investment property. I've got X amount of dollars down. Here's my credit. I've been making payments on my other obligations. Here's how much money I make. Here's how much money I have at the bank. They look at that. They look at the risk. Good risk, approved. They if you default on the property and it's happened to be upside down, you're still responsible for that difference. So they have a recourse against you. It's not allowed under IRA. That's why it has to be non-recourse loan. And non-recourse means that when you qualify for a property or for a loan, the lender doesn't look at you, how much money you have or how much money you make or what your credit is. They look at the property and how much money is in the IRA. So if you ever default on the loan, the lender can take the property back, but they cannot come after you personally or after your IRA assets. So the property itself is the only recourse that lender has. There's not a lot of lenders who will lend on that, but there is a nationwide bank that we work with, and you can get, between 20 to 50% down. You need to come up with those loans, and rates are higher also because the lender is taking more risk.
Aren't those just short-term loans, like a hard money loan?
Yeah, you can definitely use private money, yeah, but again, it has to be non-recourse. The loan documents must say that it's not a non-recourse loan. Providing goods or services, like I said, you can have your father work on the property or yourself. Transfer or use for the benefit of disqualified person income or assets of the plan. So you can transfer a property that you already own, or you cannot sell the property to yourself. Now, one way to actually, if you you buy a property inside of your 401k, actually, what I might do with the lot, because after you tune 59.5, you can take a distribution, and it's not taxable in a lot. So I can take the property out as a whole, it's not going to be taxable. Now, if you're in a taxed account, in a pre-tax account, then you can still take the property out, pay taxes on that, and then you own it in your own name. It's also a possibility. And then receive any consideration. So you can actually, here's an example. So if you're a real estate agent and you buying a property for your 401k plan, then you can't actually act as a real estate agent on that transaction and receive your commission, real estate commission. You have to give that deal to somebody else and then have somebody else give that deal. So you can't actually provide that service to the client. Buying the real estate inside of IRA or 401k is very simple. All of the gains, either tax sheltered or tax free in the case of Iran. Talking about that. You actually pay the taxes of the future. Right? You defer taxes as long as you can. In Iran, it's completely tax free. Now, one of the things that you need to realize that all of the income and profits that are generated by the property or the investment, they must go back into the retirement account. You can't use them now. And then all of the expenses that related to the property, they must go or be paid from the account. You can't pay from the personal funds. Here's another thing that just comes to mind. Why a custodial IRA in some cases can be really, really difficult. This guy, I can't remember who it was, I just remember the case. We were talking a couple of months ago. Oh, I remember who it is. The guy was referred to me by somebody, he lives in San Diego, but he got a self-directed IRA with a custodian. He's doing this property, it's a rehab deal somewhere out of state, and he needs to pay a contractor. And he submitted requests to the custodian for a check 3 times, and he never got the check. I don't know what happened, but that's what he told me. So what he did, he actually had to pay the contractor out of his personal money, and that's a prohibited transaction. So it actually kind of forced him to violate the rules. You know, IRS might never find out about this, but you know, he actually violated the rules. And that's the beauty of the sole 401k, that you just control it yourself.
If the IRS did find out about that transaction, what would be the penalty for something like that?
It will be considered, they will disqualify the account, so he will be taxed on so whatever the account is, they will say, okay, it's not a qualified account anymore.
So they give him
he
back
will be taxed
full amount, tax the full amount.
Yeah.
Gotcha, okay.
Like if he took a distribution out.
Gotcha.
I think that's the consequence.
Okay.
Yeah.
On the SCPR, do they have any of these benefits, or is it any way?
They don't.
No.
None of those benefits are available. All right. Well, that's about it. Do we have some time for questions?
Yes, you're up to 8:30.
Can we open the doors, please?
Yeah.
Yeah, it's gonna be stuffy.
We're fine.
There
we go. There we go. Yes.
All right, so now what I do offer to you guys is a free consultation. You probably have my card or my flyer there, and my number is here. So if you want to talk to me one-on-one, you'll get some of the questions, but if you want to set up a one-on-one consultation, you can shoot me an email or call the office and we'll schedule. Obviously, it's going to be over the phone because I'm not from around here. But if you're ever in Orange County, you're free to and welcome to stop by our office and come and visit us. So we do have a few minutes for some questions. So if you guys want to kind of revisit some of the things that I had to fly over.
So as far as contacting you, we can give you a call on the phone, email, what will you?
Yeah, either way, a phone or email, and you do schedule a consultation.
Okay. because I've got self-directed checkbook control with my son and daughter combined in that, and I want to try to split those two up now that they're getting older.
Yeah.
So you could kind of help us work through that and,
Sure, yeah, you can definitely set up your own accounts and transition and, simplify your situation. And we're still doing some rectifier LLCs as well, but they are, they're more complex, they're more costly, and just, from the administrative standpoint, more work involved.
right.
Here you have to deal with the LLC or with the custodian, just a lot simpler and cleaner. And plus, all of the other benefits that come with it.
How about asset protection? One reason people do an LLC is for asset protection. What is the asset protection like?
Well, as far as the asset protection, you're talking about, like if you have a large account and, separating assets from each other,
Mm-hmm.
you can do the same thing here. You can set up LLC under a sole 401k, and one LLC on one asset and then another LLC on another asset. The main reason people do IRA LLC is to obtain the checking control, not for the asset protection
Gotcha. Okay.
reasons. It comes with that, but it's not the main reason why people do that.
And you do have to have an LLC with the solar?
You don't have.
You don't have to.
LLC.
Okay, good.
You could if you wanted to separate your assets.
You don't have to.
But, I think a better way and less expensive way to do that will be to probably set up a land trust.
Okay.
Set up a land trust and each property be owned by a land trust. So this way it's going to be, no one is going to know what's in there.
Okay.
Yes.
What kind of aging do you have in taking profits out for 401k? I understand it's 5 years with the Roth.
It's what?
I understand it's 5 years that you have to wait to take, say you're over the age of.
Yeah, with a Roth, there are same rules apply as a Roth IRA, so you have to wait 5 years before you can take out, but not the traditional. Traditional, you can take contributions after 59 and a half. So the rules are the same.
So did you say you can convert from traditional IRAs to the solo,
You can,
and not from the Roth?
not from a Roth.
The last few years I've been converting from traditional to
To a
Roth.
Yeah.
Any ideas? And then this year I can recharacterize it. So,
Well, depends on the amount that you have. If you have a Roth IRA with sizable amount in there, then yeah, there's nothing you can do to move it into a Roth IRA, solo 401k. You've got Roth IRA and you just gotta deal with that. One of the things that I think somebody did is they had not a lot of money in a Roth IRA. So they started solo 401k and they just made contributions to that and they invested that in real estate and they're using a Roth IRA just for other investments. It's still a way to diversify. So they're investing in the market using Roth IRA.
So if you had 5,000 or 8,000, you might just pay the taxes on it and close that down?
Well, in a Roth IRA?
Yeah, if you didn't have that much in there.
Roth IRA, actually, you don't have to pay taxes on your contributions. If you have a Roth IRA, your contributions can be taken out at any time. Because you already pay tax on that. It's only the earnings that you will be taxed if you take it early.
So that can be taken out of the Roth and put into a solo.
Well, again, not just like that.
Right.
It has to be from the earned income. You have to have earned income in order to contribute into solo 401k.
From earned income.
But if you spend earned income on yourself and you still want to make contribution and the income allows you, then yeah, you will take the money from there and put it into a solo 401k.
Okay, so just start one up and let the other just do what it's been doing. Okay.
I just clearly really need $100,000 business. Can you help with that?
Donation.
I so wanted to start contributing to this today, and I'm such a big W-2 employee.
Yeah. Well, we can talk. Maybe we can brainstorm and I can give you some ideas.
Inspire people to be able to do something that people.
We actually, I'm starting another business to help people start businesses.
I thought you were. That's why I
Yeah.
asked you. I thought you would do Yeah.
We actually, we got some really good ideas with the partner on stuff.
I'll call you. Okay.
And you
Okay, guys, thank you for listening, and I'm gonna stick around after the end, so feel free to come and chat.
You've got cards and you've got brochures you can hand out here. There,
Yeah,
there you go.
I've got,
Okay.
I think most of you guys got one of my brochures of all.
All right.
Thank you guys, you done something?
Thank you very much. Thank you.
Thank you very much. Okay. So, we've got,
Take a break.
I think we had maybe one vendor table. Joel, he wasn't feeling too good, so he took off. So he's not gonna make much of an announcement about the contracting work that he does. I don't think we've got anybody else vendor-wise that has anything to say. So, in any case, what we're gonna do now is move on. If there's any wine left, you guys wanna grab some, be my guest, and we're gonna have, Michael Mirando. Michael Mirando is gonna be up here to tell you locally what they're doing here with Kimberly Financial. So we've got somebody here that'll be in town all the time. He's got a lot of great information, so if you wanna grab something, come on back.
Do you want to take a break? Does anyone need to take a
Please.
break?
Yeah.
Why don't we take a few minutes and then we'll come back, yeah.
Okay, that
Cool.
sounds great.